Hi. In this session, we enter in one of the most complex topics of this course, valuation. We will be looking at the introduction to valuation, and then session 6, we will be looking at the main or the first valuation methods that we are interested in exploring. First of all, as we enter into valuation, we need to be clear about what are our main challenges as we try to value a project or a company. First challenge we face, to be able to get or collect and then adapt financial information of a company. It's not easy. Sometimes it's not available, sometimes it's difficult to access, sometimes, as we see different years, it has been recorded in different ways. So we need to be able to harmonize that information and make it valuable financial information for our valuation. So once we have this, then we need to be able to select which is that valuation model that will help us to fit better with the type of business or project we have. You will see that we have many different options. For example, discounted cash flow with one stage, multiple stages. We can use market methods. It will be important that we understand the difference among those methods and which one is the best one for the type of business we are trying to value. We will also see that this is particularly difficult for early stage or pre-revenue companies. Those are companies that don't have a track, don't have a clear reference, don't have a historical evolution, and this makes it particularly difficult to value those type of companies. Something that we need to remember to clarify what is the concept of value. Here we have this nice definition of what is fair market value. Value is not the same in many situations as price. But in this case, you will see how the IRS, coming from the USA, will try to find a value that matches with price. So what they do is, what is fair market value? Fair market value is the price at which the property would change hands between a willing buyer and a willing seller. But then they add conditions. The first condition is that the buyer should not be under any compulsion to buy, and the seller should be under no obligation or compulsion to sell. So both parties have a reasonable knowledge also of the products and the facts that are affecting those assets that are being transferred. Then we will understand that there are three also differences in the concept of value. One will be the liquidation value, another aspect is the intrinsic value, and finally the investment value. Most of the time, as we discuss and analyze a company, we will be looking at the intrinsic value and the investment value. Liquidation value is only for those cases where the company might be under pressure to sell and dispose of all the assets available of the company. There is the very good video from Aswath Damodaran that I strongly recommend that you can watch, and he does also a presentation of these first elements that we need to take into account as we enter into this complex topic of valuation. Complex, you will see, not because it's difficult to understand, but because we tend to make the models too complex even when we could just have a better and more simple solution. We will also be looking at the assignment 4 that is starting at this point. Now let's switch to the following session that offers the introduction to the valuation methods. In this session, the objective changes quite a bit. Here what we want is not just to get an overview of what is valuation, but here we are trying to understand two of the most used methods, asset-based method and discounted cash flow. There are other methods, for example, market method or option-based method. You will see that we use discounted cash flow and income method as a similar term. They are not exactly the same. You will see that discounted cash flow applies to the specific elements related to the use of free cash flow to calculate the present value of a company. The income method could also be used for other types of calculations. For example, even if we want to use dividends or other elements. What is the asset-based method? Very simple. So it's the fair value of tangible and intangible assets. What we will see is that this method is especially useful when the company has no revenues, no performance in the market. So let's say that it's those situations that the company has not generated any organic goodwill. So the company has not a presence in the market that would create additional sources of value of those assets besides their, let's say, liquidation value. So that's what we try to do. This asset-based method is also similar to the valuation by parts, but that's another story that we will look further on later in the course. What we need to understand is this asset-based valuation is, for example, useful if an early stage company needs to liquidate, and maybe they have patents or other elements that might have value, but they might not have been able to bring them to market. Here, now we take a break and we do an activity. The activity consists in doing an asset valuation, and then you will need to take a side, buy or sell. We will be distributing people in different groups, and you will be trying to find a selling price, and other people will be trying to find a buying price. The objective will be to find an agreement. The interesting thing is that you will see how we find for each of the sides different prices for all those possible assets. Here we need to assume that buyers are interested in buying all of them, otherwise we will just not be able to find an agreement. Finally, now we are changing topics. We are leaving the asset-based method and we are entering in the income method. The income method, and this is important, combines three elements: the present value of future cash, free cash flow, that this is a concept that we need to spend a bit of time to understand, and the cost of capital. The steps that we need to follow are quite easy. First, we just need to do projections of each year, which is the free cash flow that the company will generate each year. Then we need to determine the discounted value of those future cash flows. And then we just need to aggregate those discounted values. You will see that at the end we will need to do some modifications depending on which definition of free cash flow we have used. An initial caveat. We say income method, but you will see that most of the time we use the concept of free cash flow, not the net income. Why does it happen? Because we are actually looking at the cash that is generated not only to the shareholders but also to the creditors. So this is like the total cash that has been created. This is the process that allows us to get to the free cash flow to equity. This is one of the options. When we use this free cash flow in our calculation, the final value that we get is the firm's equity value. This is different from the firm's enterprise value, as we will see in the next slide. How do we do that? A few steps. We get the net operating profit after taxes. We subtract the change in capital expenditures. We also subtract the interest after tax, or the after-tax interest. And we add the projected change in net borrowings. We are getting now the free cash flow to equity. The other option we have, we can use the free cash flow to firm. This is more general. What we have here is the projection of the future cash flows, but in this case, the total is giving us the firm enterprise value. How do those things connect? Enterprise value minus market value of debt is the firm's equity value. How do we get this calculated? Starting from the projected free cash flow to equity, we subtract the change in net borrowings and we add the projected after-tax interest. So what you're seeing is that this is the same as if we had stopped in the first step in the previous calculation. So if you get the projected net operating profit after taxes and you subtract the change in capital expenditures or capex, then you are getting the projected free cash flow to the firm. Sounds easy? It is easy. So now we need to start moving things from the future to the present. So how do we do that? Very simple. We use a discount rate and we need to have the years into account. It's not the same if something is happening in 6 months, in 1 year, than in 5 years. Very simple formula that links the present value to the future value by dividing it by the interest, adding the 1, and then using the exponential, the number of years. This is because we are assuming that this is a compound rate. Here we have a couple of examples that you can look at. But the whole thing we are doing here is to try to bring those future cash flows to the present day. We need to be aware that there is this specific element of the terminal value. So what happens with the cash flows when we stop projecting? Because from that year onwards, we will have a terminal value of that company. We need to have that value also generated and also brought to the present day. Now it's the moment to take a break and work on the internal rate of return and net present value. We will have activities plus a Padlet to learn about this. Here you will need to be comparing different project portfolio, selecting which one makes more sense depending on if you look at net present value or internal rate of return. You will see that those are conflicting sometimes. We need to understand how to use them and when to use them. Finally, now we have been able to understand the present value of future cash, the free cash flow. Now it's time to look at the cost of capital. The cost of capital has a series of elements that we need to be aware of. For example, that companies that invest in highly risk projects might have a higher cost of capital. There are other elements, as you see below, that need to be taken into account. Finally, what is important is that cost of capital needs to be weighted between what is the shareholder's cost of capital and the debt holder's cost of capital. To wrap up, how do we value a private firm? First, project each year free cash flows, determine the value of the free cash flows when we bring them to the present using the WACC, aggregate those discounted values and we get the enterprise value, subtract and add, before any cash flows that are still available in the balance sheet, cash that is available in the company, and then subtract the value of debt. Now we have equity value. Now we will have time to discuss assignments 4 and the future assignment 5. As takeaways for this session is that we have seen two of the easy methods to understand valuation, asset-based method, a bit more complex discounted cash flow, and now we can start using them and applying them in our exercises.